Welcome back. My name is Rick Melero with His Capital, and today we're doing video 2 of a 10-part series about private lending. Today we're going to talk briefly about what hard money is and what the differences are between hard money and traditional institutional investors and how you can properly leverage without losing everything. So hard money loans, as you can imagine, they have a stigma to the name, and that is ultimately the stigma that they gave investors that began to invest in the millions of dollars to other investors at a higher interest, perhaps a little bit higher loan to value and aggressive terms. Now, the problem is whenever you default, the reason why they have the nickname hard money is because they go after you, they take your assets and you lose everything you put into the deal, right? And some of these lenders became very well known for doing what we call loaning to own. And you have to be very careful because there are some wolves in sheep's clothing still in the marketplace. I deal with some on a regular basis where I'm trying to bail out a client who met one of these investors and they set them up to fail. And in some cases, one of the ways in which they set them up to fail is that they give them a full leverage play on their deal, but the stipulation is on the documentation. And so the investor buys the property with all this leverage. The lender knew what he was getting into, and he put some clauses in the agreement so that the moment you pass that 6-month mark, in some cases, sometimes I've even seen as early as 3 months, they immediately begin the foreclosure process. They have tons of fees that they charge you, and that forces you to have to do one of two things. Number one, pay them off with the extreme fees they charge, or B, give up the property so they don't go after your personal guarantees. And so that's one of the reasons why private lending became known as hard money, because it's no joke, right? Now, that being said, this business produces such great returns, and the terms of the loans are typically about 12 to 18 months. So what started happening is bankers, insurance companies, and other institutional partners started realizing that this is a really unique business model. It's secured by real estate, you're dealing with experienced operators, and so they started buying mortgages from private lenders like us. And what that did is it created a whole new influx of capital, and it helped the hard money business evolve. So the truth is, if you're dealing with an institutional lender or a hard money lender that is doing $3, $5, $6, $7, $10 million a month in loans, chances are that that hard money lender is funding loans and selling them off to these institutions. Now, why is this portion important? Here's why. Because that means that if somebody's funding paper, like us, to sell to another institution, there is going to be a set of guidelines that is across the board something that we look at. Why? Because if we fund a deal, our goal is to sell the paper. That means that the paper has to have been underwritten in such a way that these institutions are willing to buy it. And so in essence, without really knowing, the big institutional capital has helped to shape the actual standards of due diligence for deals. And so what's beautiful about this, but also it's frustrating, is that whether you're dealing with a private investor that's got millions or an institutional level investor, that means that the lenders have gotten very wise to what we call risk mitigation. Because now we're not looking at just 4 or 5 loans, whether they worked or not. Now we're looking at portfolios of $2 billion to see the risk. And we find that anyone below this credit score has a higher ratio of default. Or anyone with this level of experience has a higher level of default. Or anybody in this particular market has a higher risk for losing money or default. And so that data gets transferred between these investors so that they can make wise decisions. And from that information, we start getting conditions for our due diligence. So what I want to do is break this down. When you're dealing with a private investor who doesn't have this level of sophistication, in many cases, this investor is making a decision based on their trust with you as the investor and whether they like the deal or not. And that will determine if they want to move forward with the deal. Now, how aggressive they are on funding your deal determines with how much money they have in their pocket, which is why there's a lot of inconsistencies. So 1 month, if I have $1 million, I may want to give you more money so that I can put that money to work. But when my $1 million are tied up and you bring me another opportunity and I don't have the money, well, I start getting a lot pickier with your deal, right? Because I'm trying to buy time until I get a payoff so that I can fund your transaction. That's just human nature. Now, when it comes to the institutional level investor, when we're funding you to get our money back, what we want to do is make sure that we're mitigating risk for you, for ourselves, and for our institutional partners that we're selling the paper to. So generally, and I'm going to keep this as simple as possible, when we're doing a hard money loan, we're taking a look at a couple of key components. And we call it the pillars of underwriting, but for the sake of this video, I just want to share with you the components that are tied to a couple of key things. So let's begin with the operator, which is the borrower. Okay, so when I'm funding you, I'm asking myself, does the operator have experience? And experience is an essential piece, because what we have learned over the years with the hundreds of millions of dollars that we've been a part of is that the people with experience are less likely to default on deals or lose money when it goes sideways than somebody who's new, right? That's the truth. So that has a bigger weight for our due diligence to make sure that we're dealing with a client that has experience. But we've also seen experienced clients lose money, right? So we don't want to get stuck in that situation. So what's the next thing? Well, the next thing we look at is liquidity. Does this borrower have enough money in the bank to cover the closing costs, whatever is due to them to put as a part of the down payment, and for 6 to 12 months of interest reserves? Now, the reason why this matters to me is because as your investor, I want to make sure that if this deal takes longer than 5 or 6 months, that you have the money to make the payments so that you're not going to default. Or as a perfect example, if I give you $100,000 for repairs and you're off by 10%, do you have enough money to finish the project? Because if you don't, we're all stuck in this deal, right? So does that make sense? I want to give you that picture. Now, from that perspective, we looked at experience, we looked at liquidity, and then we look at your credit history. Now, why does credit history matter at all if we're doing a hard money loan? Well, I'm going to give you some really important information to understand that should encourage you to always make sure that you have a good credit score. So while FICO isn't necessarily as important to us, when we look at credit, we see how many trade lines you have. We see a pattern of whether you're borrowing more money than you're paying down. And that's an essential piece because we've worked with investors that bit off more than they could chew, and you can see in their credit score the trend of them borrowing more and more money to try to survive. And the last thing we want to do is give you the last straw that breaks the camel's back. That's just being honest. Part two, because we're able to see a payment history, we can see if there's already a delinquency trend. And what we have learned is that people that are late on mortgages, chances are they're not going to have a problem being late on your mortgage if something goes south. So again, this gives us a picture of the character of the borrower. And this is one of the reasons why this is such an important piece. I'll give you an example. I used to not even care about the FICO score. But you know what I found out? After about $20 million in paper performing, what I noticed is that 60% of my defaults came from borrowers with a FICO score under 620. Now, I don't know why, but if that percentage is that high, what that tells me is that somebody who really didn't care about their FICO score may have some type of character issue or financial situation that may impact my investment. And that's one of the reasons why we are such sticklers about verifying the whole picture of experience, liquidity, and the credit score. Now, once we're done with the operator and vetting the operator and we feel comfortable with moving forward, then we go to the true hard asset and we want to analyze the deal. So what we want to analyze is first and foremost, does the borrower make money on this deal? You will be amazed how many borrowers bring us opportunities with such razor tight margins that if something goes wrong, they literally worked for me for free. That is not a win-win. And so if you want to work with a lender that is not lending to own, you need to connect with a lender that's asking themselves, does my borrower make money? And if they don't, why are they doing this deal in the first place? So that's the first thing I analyze. The next thing I analyze is, of course, in this marketplace, are the repairs in the repair list going to match the resale comps in the market? Or is my client under repairing or in some cases over repairing the project? The reason why this is important is because in some markets, if you under repair, you are going to guarantee yourself that you're going to have challenges selling that property. And at the end of the day, I get paid off either when you pay me or when you sell the property, right? So this is why it's so important to understand the exit strategy and if you're doing the repairs at a standard that is going to create demand, especially in a lower market. Now, the other thing we look at, and believe it or not, this is an essential nugget that I believe has a lot to do with hard money lending, and that is location, location, location. So here's another nugget that most investors won't tell you, okay? I was working with an institution. They have about $2 billion on their books. We've sold them hundreds of millions of dollars over the years, and we started sharing intel. And what we learned is that properties that were in rural markets, meaning in areas that have a very low population, that are away from the main markets, And in reality, when we pull comps, the comps are further than 3 miles from the subject property. That's the parameter. What we found is that when those properties went on delinquency, or when the market changed, those were the highest impact property types. And in fact, they represented close to 25% of lenders' losses, because even when they took the properties back, they had a hard time reselling it or renting it because of the fact that the property was in a rural area. So for us, when we're analyzing a deal, we want to make sure that you're in a location that will be able to pivot for a rental property or pivot for a sale. But if it's a rural market, we like to educate our clients because most investors don't even realize that that is a major risk that they're walking into. They're just looking at a lower price, some potential equity, but they don't connect the dots of the risk. And so again, when we analyze the borrower, we begin to dive into the deal and the location and the profitability to make sure that it's a win-win. And once that happens, then we go to the last stage, which is where we make sure that we have the proper insurance coverage, we make sure that the title is clear, and we make sure that we have the proper security instruments to protect our investors and protect ourselves. And so my friends, whenever you're working with a lender who has this level of experience, understand that they're going to want to help you and protect you. So if I say to you, this deal is a concern of mine, you should listen closely because I'm looking for your best interest in mind. But be wary of people that are just giving you loan to value ratios, because in many cases, those are the wolves in sheep's clothing who are just looking out for themselves and they don't care if you lose everything you have. So again, I hope you've enjoyed this video. I know we unpacked some of the key elements to actually underwriting and funding hard money loans so that you understand what those loans look like.
Thank you so much for taking the time to watch this video. I hope it was valuable to you. Please make sure that you like, subscribe, and share. And also, if you have some additional tips or strategies that you want us to cover with real live action projects that we fund, feel free to put those in the comments. We look forward to sharing with you more content. Until we meet again, don't forget to invest with purpose.